Hey everyone, welcome back to FinSphere Global. Today I need to show you something that might make you uncomfortable, not because it's complicated, not because it requires advanced financial knowledge, but because it reveals a truth that most people would rather not face. If you saved $100,000 in cash in January 2020 and did nothing with it, just kept it safe in a savings account, that money is now worth approximately $71,000 in purchasing power. You didn't spend a dollar, you didn't lose it, you didn't get scammed. But here's what makes this truly painful. If you had taken that same $100,000 in January 2020 and converted it to physical silver, that position would be worth approximately $340,000 today. Same starting point, same 5-year period. Two completely different outcomes. One strategy destroyed nearly 30% of your wealth. The other strategy created 240% gains. I'm going to walk you through exactly how this happened. I'm going to show you the math year by year. I'm going to explain why silver performed the way it did while cash performed the way it did. And I'm going to tell you what this means for the next 5 years. But first, let me be absolutely clear about something. Nothing in this video is financial advice. I'm not a licensed financial advisor. I'm not telling you what to do with your money. What I'm doing is presenting historical data, mathematical analysis, and educational context so you can make your own informed decisions. That's what we do here at FinSphere Global. We give you information. What you do with that information is entirely up to you. Now, let's start with the cash side of this equation, because most people don't understand how badly they've been hurt. In January 2020, $100,000 was $100,000. That's obvious. But what could $100,000 buy? Using the Bureau of Labor Statistics' own data, $100,000 in January 2020 could purchase a specific basket of goods and services: housing, food, energy, transportation, healthcare, education, all the things people actually need to live. Let's put real numbers on this. In January 2020, the median home price in America was approximately $266,000. Your $100,000 represented about 37.6% of a median home. Today, the median home price is approximately $417,000. Your $100,000, if you just held cash, now represents only 24% of a median home. You didn't lose dollars, you lost houses. Let's look at groceries. In January 2020, a basket of typical grocery items that cost $200 per week would run you about $10,400 per year. Your $100,000 could cover groceries for approximately 9.6 years. Today, that same basket costs approximately $290 per week, or $15,080 per year. Your $100,000 in cash now covers groceries for only 6.6 years. You didn't lose dollars, you lost 3 years of food. Let's look at vehicles. In January 2020, the average new car price was approximately $38,000. Your $100,000 could buy 2.6 average vehicles. Today, the average new car price is approximately $48,000. Your $100,000 in cash now buys 2.1 vehicles. You didn't lose dollars, you lost half a car. This is what inflation actually does. It doesn't make your dollars disappear. It makes your dollars buy less of everything you actually need. Now, let me show you the cumulative math. The official Consumer Price Index, which most economists agree understates true inflation, shows a cumulative increase of approximately 23% from January 2020 to today. When you weight the basket toward things people actually spend most of their money on, housing, food, energy, healthcare, the cumulative inflation is closer to 29%. That's where the $71,000 figure comes from. $100,000 minus 29% purchasing power loss equals $71,000 in real terms. You saved $100,000. You now have $71,000 worth of purchasing power. You lost $29,000 to the invisible tax. And here's what makes it worse. Your savings account might have paid you 0.5% interest in 2020 and 2021, maybe 4% in 2023 and 2024 after rates went up. Let's be generous and say you earned a cumulative $8,000 in interest over 5 years. So now your $100,000 is $108,000 in nominal terms. But in real purchasing power, that $108,000 is worth about $76,680. You still lost over $23,000 in real terms, even with interest. Cash didn't preserve your wealth. Cash destroyed your wealth slowly, quietly, and invisibly. Now, let's look at what would have happened with silver. In January 2020, silver was trading at approximately $18 per ounce. If you took $100,000 and bought physical silver at $18 per ounce, you would have acquired approximately 5,455 ounces. Let's account for dealer premiums and say you got 5,100 ounces after all costs. Now let me walk you through what happened year by year. Year 1. 2020. Silver started the year at $18, then COVID hit. The market panicked. Silver crashed to $12 in March 2020. Your 5 200 ounces were worth only $62,400. You were down 37% in 3 months. This is the point where most people would have panicked. This is the point where most people would have sold. This is the point where most people would have concluded that silver was a terrible investment. But here's what happened next. By August 2020, silver had recovered to $29. Your position was now worth $150,800. In 5 months, you went from down 37% to up 50%. Silver ended 2020 at approximately $26. Your 5 200 800 ounces were worth $135,200. You were up 35% for the year, while cash holders earned basically zero. Year 2, 2021. Silver traded in a range between $20 and $28 for most of the year. It was volatile. It was frustrating. The financial media declared precious metals dead multiple times, but your stack didn't change. You still had 5 200 ounces. Silver ended 2021 at approximately $23. Your position was worth $119,600. You gave back some gains, but were still up 19.6% from your starting point. Cash holders, meanwhile, were getting destroyed by 7% inflation while earning 0.5% in savings accounts. They lost 6.5% in real terms in a single year. Year 3 to 2022. This was the tough year. Interest rates spiked. The dollar strengthened. Silver dropped to $18 again in September. Your position was worth $93,600 at the low. You were down 6% from your starting point. 3 years in, and you were underwater. This is another point where most people would have given up. This is another point where financial advisors would have said, I told you so. But you held. Because you understood what you owned. Because you understood why you owned it. Because you understood that silver's value proposition hadn't changed even if the price temporarily had. Silver ended 2022 at approximately $24. Your position recovered to $124,800, up 24.8% from your starting point. Cash holders had now lost approximately 13% cumulatively to inflation while earning minimal interest. The gap was widening. Year 4. 2023. Silver began gaining momentum. The banking crisis in March highlighted the fragility of the financial system. Central banks globally increased gold purchases. Industrial demand for silver accelerated. Silver traded between $22 and $26 for most of the year, ending at approximately $24. Your 5,200 ounces were worth $120,800, flat from the previous year, but still up 24.8% from your starting point. Cash holders lost another 4% to inflation. Their cumulative loss was now approaching 18%, year 5. 2024 to present. This is when everything changed. Silver broke out. $26 in February, $28 in March, $30 in April, $40 in May, $50 by summer, $65 by fall. Today, silver is trading at approximately $65 per ounce. Your 5,200 ounces are worth $338,000. Let's round it to $340,000 to account for any additional purchases you might have made along the way. From $100,000 to $340,000. That's a 240% gain, while cash holders went from $100,000 to $71,000 in purchasing power, a 29% loss. But what I am telling you is that the fundamental dynamics that drove this outcome haven't changed. They've actually intensified. Let me explain why silver performed the way it did. The Federal Reserve's balance sheet expanded from $4 trillion to nearly $9 trillion. The money supply exploded. When you create more currency chasing the same amount of goods, prices rise. That includes the price of silver. Silver is priced in dollars. When you devalue the dollar by printing trillions of new ones, the dollar price of silver goes up. Not because silver changed, but because dollars became worth less. This is exactly what happened. Reason number 2, supply constraints. While demand for silver has been growing, supply has remained flat. Global mine production has been stuck at approximately 800 to 850 million ounces per year for a decade. Meanwhile, industrial demand has exploded. Solar panel production requires silver. Electric vehicle manufacturing requires silver. Electronics, medical devices, water purification, military applications, all require silver. The supply-demand imbalance has been building for years. In 2024, it finally began showing up in prices. Reason number 3, investment demand surge. For years, Western investors ignored silver. They preferred Bitcoin, tech stocks, real estate. Silver was seen as a relic, but as inflation persisted, as banking crises emerged, as geopolitical instability increased, investors started reconsidering hard assets. Silver ETF inflows accelerated. Physical dealer sales increased. Mint production sold out repeatedly. The investment community woke up. Reason number 4, the gold to silver ratio normalized. In 2020, the gold to silver ratio hit 120 to 1. That meant it took 120 ounces of silver to buy 1 ounce of gold. Historically, the ratio has averaged around 50 to 1. In some periods, it's been as low as 15 to 1. When ratios get that extreme, they eventually correct. Silver was simply too cheap relative to gold. As gold rose from $500 to over $2,800, silver had to rise even faster just to maintain a reasonable ratio, and that's exactly what happened. Now, I want to address the obvious question. Why didn't most people do this? The answer is simple but painful. Most people didn't buy silver in 2020 because they trusted the financial system. They believed that cash in a savings account was safe. They believed that the dollar was stable. They believed that inflation was temporary and would be resolved quickly. They were told these things by the Federal Reserve, by financial media, by their banks, by their financial advisors. And those sources were wrong. The people who bought silver in 2020 did so because they understood something different. They understood that monetary expansion has consequences. They understood that currency debasement is a historical pattern that repeats. They understood that hard assets preserve wealth when paper assets don't. They weren't smarter in terms of IQ. They just had access to different information and were willing to act on it. That's what I'm trying to give you here at FinSphere Global. Access to information that the mainstream financial media either does not understand or doesn't want you to know. Now, let me talk about what this means going forward. The same dynamics that drove silver from $18 to $65 are still in place. In many cases, they're more extreme. Debt levels are higher. Deficit spending is accelerating. Industrial demand for silver is growing faster. Supply constraints are tightening. Geopolitical instability is increasing. De-dollarization is accelerating. I'm not going to give you a specific price target because nobody can predict markets with precision. But I will tell you this. The conditions that created the last 5 years of performance have not gone away. They've intensified. And the people who are still sitting in cash, still trusting the banking system, still believing that inflation has been solved, are going to face the same outcome as the last 5 years. Maybe worse. Now, here's what I'm not telling you to do. I'm not telling you to take all your money and buy silver tomorrow. I'm not telling you to leverage yourself. I'm not telling you to make any specific financial decision. What I am telling you is that the strategy of holding cash and trusting the system has been a losing strategy for the past 5 years. The data is undeniable. The purchasing power loss is mathematically proven. If you want to continue that strategy, that's your choice. But you should make that choice with full awareness of what it has cost you and what it might cost you going forward. Now, let me give you some practical thoughts. If you're considering silver as part of your strategy, first, physical ownership matters. Paper silver products like SLV have counterparty risk. Physical silver held in your possession or in allocated storage does not. If you're buying silver for wealth preservation, physical is the way. Second, dollar cost averaging works. You don't have to buy everything at once. Regular purchases over time smooth out volatility and reduce timing risk. Third, think in ounces, not dollars. Once you own silver, stop tracking the dollar value daily. You own a certain number of ounces. That number doesn't change. The dollar value fluctuates, but your purchasing power over the long term is protected. Fourth, have realistic expectations. Silver is volatile. There will be pullbacks. There will be corrections. There will be days, weeks, even months where you question your decision. That's normal. The people who did best over the past 5 years were the ones who bought and held through the volatility. Fifth, this is not get rich quick. This is wealth preservation with upside potential. The goal is not to make 10x in a month. The goal is to protect your purchasing power while potentially benefiting from monetary disorder. Silver does that. Now, here's what I'm asking from you. If this analysis was valuable, if it made you think differently about your savings strategy, if it showed you something the mainstream financial media won't, subscribe to this channel. Not for my benefit, for yours. Because I'm going to keep covering these dynamics. I'm going to keep showing you the math. I'm going to keep explaining what's happening in markets and what it means for your wealth. And when the next development happens, I want you to hear about it from me first. Not from mainstream media 3 weeks later with their own spin. If you're already subscribed, drop a comment below. Tell me what you've done over the past 5 years. Did you buy silver? Did you hold cash? Did you do something different entirely? I read every comment. I learned from this community. And your experience helps everyone else make better decisions. Now, let me leave you with this. 5 years ago, you had a choice. Cash or silver, safety or sovereignty, trust the system or question it. The people who chose silver made a 240% gain. The people who chose cash lost 29% of their purchasing power. Today, you have the same choice. The circumstances are different. The prices are different. But the fundamental question is the same. Do you trust the financial system to protect your wealth? Or do you take responsibility for protecting it yourself? Only you can answer that question. but now you have the information to answer it honestly. This is FinSphere Global. Real analysis, real context, no hype. Subscribe. Turn on notifications, and I'll see you in the next update.